So, if you're trying to follow the housing market right now, you're probably feeling some serious whiplash. I mean, the headlines are screaming crisis, but then your local real estate agent might be telling you it's the hottest market they've ever seen. So, what's the real story? Well, the truth is, the whole idea of a single U.S. housing market, that's officially a myth. It's gone. Today, we're going to dive into the data that proves the market has actually fractured into two completely different realities. Okay, let's just get right to it. Crash or boom? Which one is it? Because depending on where you live, you can make a really strong case for either one. And this contradiction is confusing everyone. Buyers, sellers, you name it. But by the end of this, you'll understand the two hidden forces that are literally pulling the market in opposite directions. All right, so let's start with the number that's got everyone spooked. For 9 straight months, foreclosure filings in the United States have been on the rise. 9 months. That's a trend you just can't ignore, and it's the one thing that has everybody thinking, here we go, it's 2008 all over again. But is it really that simple? And this is the great contradiction we're talking about. While those foreclosure numbers are ticking up, home prices in places like the Midwest and the Northeast are just smashing records, hitting all-time highs. So you've got this rising financial distress happening at the exact same moment as a price boom. This isn't a normal market, folks. It's a full-blown paradox. Okay, so let's pull back the curtain on these scary foreclosure numbers. Is this threat for real, or are we all just seeing a mirage? Let's find out. This chart right here puts everything into perspective. Yeah, foreclosure starts are up, hitting around 23,700 in November. But just look at that number compared to the historical monthly average, or the absolute peak back in 2010. We aren't even close to a normal level of foreclosures, let alone a crisis. The scale is just completely different this time around. But this is where the mirage really shows itself. While lenders started the foreclosure process on almost 24,000 homes, they only actually repossessed, as in took back the keys, on fewer than 4,000. That is a huge gap. So what on earth is happening to the other 20,000 homes where the owners are in trouble? And this right here is the absolute key difference between today and 2008, homeowner equity. See, unlike the last crash, homeowners today are sitting on record amounts of it. So if they get into financial trouble, they don't just wait for the bank to come knocking. They put a sign in the yard, they sell the house on the open market, and they often walk away with a nice check. And that simple fact prevents the flood of cheap, bank-owned homes that triggers a crash. So if a 2008-style foreclosure crisis isn't in the cards, why are some markets actually seeing prices fall? Well, let's move on, because this all builds to our core idea. The United States doesn't have one housing market anymore. It has two. The first clue is that all this distress, it's not spread out evenly. It is highly concentrated. The highest foreclosure rates aren't happening everywhere. They're packed into these specific danger zones. States like Delaware, South Carolina, Nevada, and especially Florida are feeling the pain way more than the rest of the country. And folks, this slide right here, this is the smoking gun. Just look at this difference. In Illinois, home prices are up a whopping 6.9% in 1 year. At the same time, in Florida, they're down 2.3%. How is that even possible? It's the same country, the same federal interest rates, but two completely opposite realities. This isn't just a minor variation. This is a fundamental split. So let's actually put a name to these two Americas. You've got the frozen north, and that includes the Midwest and Northeast, where the market is basically locked down and starved for homes to sell, which makes prices climb. And then you have the volatile south, where inventory is starting to flood the market, which is leading to price corrections. And the reason for this crazy split? Well, it comes down to two powerful hidden forces. So what are these invisible forces that are creating this deep divide? Let's expose the two opposing pressures that really explain everything that's going on. Okay. The first and most powerful force, especially up in the north, is something called the lock-in effect. Just think about it for a second. If you have a mortgage with a 3% interest rate, why in the world would you sell your home just to buy a new one with a rate over 6%? You wouldn't. Your monthly payment could literally double, and that one simple calculation is paralyzing the housing supply. And get this, the scale of this effect is just mind-blowing. Over 80% of all U.S. mortgage holders have an interest rate way below what you could get today. This has essentially frozen millions and millions of homeowners in place, creating a massive shortage of homes for sale in most of the country. But in some places, there's another force that's so strong, it can actually break that lock. We're calling it the insurance crisis, but really, it's a cost-to-hold crisis. In states like Florida, the cost to simply own a property, we're talking insurance, property taxes, HOA fees, it has just exploded. It's gotten so expensive that it's wiping out the benefit of having that low mortgage rate, forcing people to sell and flooding those specific markets with new inventory. Now, just when you think a place like Florida is stuck in a death spiral, there's a really interesting twist. It looks like some recent legislative reforms are actually starting to work. For the first time in years, more insurance companies are entering the state than leaving it. This suggests that while the crisis is very, very real, the market is starting to correct itself. The worst might actually be ending. Okay, so we've figured out the split market and we've identified the forces that are causing it. But what does all of this mean for you? Well, in our final section, we're going to turn all this analysis into an actual, actionable playbook for you to navigate the housing market in 2026. First things first, don't hold your breath waiting for mortgage rates to come crashing down. Wall Street is betting big on something called mortgage servicing rights. Now, in simple terms, the fact that these are so valuable means the experts don't expect a wave of homeowners to refinance anytime soon. The smart money is betting on rates staying higher for longer. And second, don't expect a flood of brand new homes to come and save the day. The Home Builders Index is currently sitting at 39. Now, anything below 50 means builders are pessimistic. And with high financing costs, they're just staying on the sidelines. That means the housing shortage we have across the country, well, it's probably here to stay for a while. So this all boils down to a pretty simple 3-step playbook for you. Step 1, identify your market. Stop reading the national headlines and figure out if you're in a frozen zone or a volatile one. Step 2, know the driving force. Is your neighborhood being shaped by the lock-in effect, or is it the cost-to-hold crisis? And finally, step 3, adapt. If you're in the South, patience is your best friend right now as more inventory comes online. If you're in the North, you might need to be willing to compromise to find a way in. The key takeaway from all of this is simple. The big national housing crash everyone is waiting for, it isn't one single event. It's a rolling series of local, targeted corrections. It's really a battle between that powerful lock-in effect and the painful cost-to-hold crisis, playing out one neighborhood at a time. And that really leaves us with the final question for you to consider. When you look at your own backyard, your own city, which of these two powerful forces do you think will ultimately win out and shape the future of your local market? Because at the end of the day, to make the right decision, you have to let the data guide you, not the fear-inducing headlines. Hey, if you found this breakdown valuable, do us a favor and hit that like button and subscribe to the MoneyWise Dollar channel for more data-driven insights just like this one. And let us know in the comments, what complex topic should we dig into next? Thanks for watching.